So even though there was too much there to discuss, I'm going to ask us to reconvene. We started this conference a little over 24 hours ago. Everything since, I think, has been at a standard that is incredible, and I'm grateful to every discussant and every speaker, as well as this incredibly high-level audience for engaging. You all, in the parlance, came to play, and it showed, and it was terrific. Not just for patrons' sake. The idea is to give Olivier and Larry the last word, and then engage in one last round of discussion with them, me a little bit, but mostly all of you. They set out, as we've said many times, a really ambitious agenda, not just for this conference, but for macroeconomic policy, for rethinking. And having them now heard and listened carefully to 2 days or a day and a half of experts, we'd like to turn to them for their reflections and what they learned, if they changed their mind or rethought anything as a result of the 2 days, but also more sparks between them and the evolution and revolution camps, if they're so inclined. Apologies, there's no fireside. We decided in the interest of time to just leave the table as it is. But Olivier, please.
Okay. Let me take a few minutes to do some real-time assessment. So there was, yesterday, the last slide had Larry having revolution, I pushing evolution. My sense of the forecast is here, which is not much is going to happen in the end. I think the fear, can you hear? Okay. The fear which dominated the last 10 years is largely gone. And I think the best forecast is not much is going to change in the end. Let me just go quickly through the various pieces. On monetary policy, I have a sense that we're going to return to something like inflation targeting, maybe flexible. I think that the kind of modifications that Ben pushed or forward guidance becoming credible is going to be discussed, maybe adopted, but this is not revolutionary or evolutionary. It's very minor changes. There's one dimension we didn't discuss where I think there's agreement, which is liquidity provision when it's needed. I think there's general agreement that was incredibly useful, and it will be done again if there's a financial crisis. But on monetary policy per se, I'm not sure that we're going to see major changes. On fiscal, I must say that I thought that our less than G line didn't play very well. There was, I think, that kind of Washington consensus remains on that, which is, yes, we should do more on automatic stabilizers, but nobody's doing anything, which is quite striking. And yeah, maybe it's a bit less dangerous to have debt, but we still have too much, so let's still try to basically decrease it. And there was no sense that we should rethink the basic principles. On financial, I thought, again, I've learned an enormous amount from all the papers and all the discussions. I thought Andy had done a great job, but my conclusion was we have increased capital ratios a bit. The optimal number is probably higher, but we're not going to get there. Anyway, it's going to be a complicated game. Let's see where it goes. I thought he was very honest at the end in saying, well, what we've done basically is patch up, and we still haven't thought about, the big question, which is what is the financial system we would like to have, rather than repairing the one that, it's a much more difficult, he was right to put this as the last question, because I think it's a very hard question to handle. But that's the one we should be thinking about, and I don't think we are there. On the 2 sessions today, inequality, I thought that was extremely interesting, but what was maybe even more interesting is inequality was never mentioned yesterday in any of the 3 sessions, which is when we discussed monetary policy, there was no discussion of distributional implications. Same thing for fiscal and same thing for financial. It may well be that macro stabilization to a first order is orthogonal to the big issues about inequality that we discussed, but the integration wasn't done. And on international, that was the last session, I actually thought that was the most ambitious in terms of saying, well, really the ground has changed. We really have, things are different. We have to, whether Gita is right that we've the dollar invoicing is really a major issue. If it is, it really implies changes in the way we think about basic mechanisms. And although yesterday there was no discussion in monetary policy of the open economy aspect, there was actually a discussion of monetary policy in that session. So I thought that was the most hopeful. But in the end, my sense is we're not going to see much change. How dangerous it is, I think if a recession came soon, it would clearly be an issue that we still don't have the means to handle it best. There was this very provocative statement by Greg Ip that maybe we're not going to have shocks anymore. And this is an eternal belief, but maybe that's true this time, in which case maybe we should not worry as much. And then the last point I would make is, so what do we do at the end of a conference? My sense is the place where really something can be done without strong political opposition is automatic stabilizers, fiscal. It seems to me that that is just left alone for no good reason. It can be done and it can be solved. And then I think for us, those of us who believe in evolution should keep saying, please evolve. And those who believe in revolution should be even stronger in their statements. And we have to keep pushing. And I shall, telling Larry to be stronger in his statements may not be a very wise remark, but strong in his statements. Let me stop here.
We segue from flute to tuba, I think.
I'll be even briefer. I think in terms of characterizing what was said, I think Olivier, I wouldn't disagree with anything Olivier said in characterizing how the world's policy thought is likely to evolve in the next 2 or 3 years. I wouldn't disagree with anything Olivier said. I think the way I would put it is this. I think there's a substantial chance, whether that means 25% or whether that means 75%, who knows, that the view I espoused yesterday, that there's a profound long-term problem of an excessive propensity to save over investment and associated low interest rates and difficulty in achieving growth in a financially sustainable way is a problem of our world right now. And if that's true, I think our existing monetary, fiscal, and financial regulatory paradigms are manifestly inadequate. And I think there's some suggestion that it might be true in the difficulty of attaining 2% inflation targets, the low levels of interest rates, the relatively inflated levels of asset values, and so forth. And I think it's also very possible that it's not true, that economies will keep growing for a while, that there won't be bad shocks, that interest rates will move up a bit, that there are 2 historic major causes of recessions. One is inflation being allowed to accelerate out of control, and the other is big asset bubbles. And we sort of got mechanisms in place with respect to both of them, and that this will be an easy era with respect to macroeconomic stabilization policy, and the main problems will be structural around some combination of growth and inequality. I think that's also a plausible view. And I think the world, by the time of the 6th Rethinking Macro Conference, 4 years from now, I think one of two things will have happened. We will have had 4 more years of stable, not fantastic growth with continuing concerns about equity, and the whole world will have come to an agreement that all the focus needs to be on structural things. Or there will have been some combination of recessions, deflationary fears and financial accidents, and there will be much greater sense of urgency around paradigm change. And I'm not sure I wouldn't claim that I'm confident that we'll be in the second. I tend to think, as a general way of having operated in life, that when you're in government, you should try to figure out what there is that most people who are knowledgeable agree on that's not done, and do it. And when you're not in government, you should try to figure out in what way the conventional wisdom could be radically wrong and point it up, not because you're sure to be right, but because that then some thought and some ideas will turn out to have been there if you turn out to be right. And that's how I would view the more insurgent secular stagnation, hysteresis, and all of that aspects of Olivier in my paper.
Before I open it up for comment, again, we have one of the most distinguished audiences we've ever assembled, including all our current speakers. I just, maybe I'm playing Trotsky to Larry's Lenin, or certainly not Stalin. But I just want to pick up on Larry's last point, and as a think tank head, make a bit more of a push. There's a saying in the resistance, be the change you want to see in the world. And I think that there is room for those of us who are not currently policymakers in terms of writing and public statement, and those who are thoughtful current policymakers in terms of private thinking, to do a bit more rethinking than we've seen. This was clearly the case on the monetary panel, fiscal panel, financial panel. It's not because these weren't, when you all weren't, and our counterparts aren't very smart people trying to do the right thing. But if we go back to where Olivier and Larry started the conference yesterday, this is in the end about a combination of a very strongly perceived failure of technocratic policymaking. We may have done as well as we could have done given the knowledge at the time, but we cannot ignore either the intellectual substance of the failures of the past macroeconomics to forecast and deal with the current or the recent past. And we cannot ignore the fact that we have to, as a community, rebuild credibility. Our collective credibility is much less than the individual credibility of the various distinguished scholars and policymakers who have spoken here. And that has to be confronted. That doesn't mean we make stuff up and we just try to pander, but it just means a little more forcefully than Larry said, I would say, we have to take seriously the recognition that, say, on macroprudential policy, as Larry and Nellie and Jeremy and Benoit put it very well. Just to pick one example, we've done as best we possibly could, I think, in terms of patching the boat as we go, but we got to get a bigger boat. Got to get a better boat. And I frankly agree with Olivier's characterization of Ben Bernanke. I think that was a very reasonable, and it's very significant for former Chairman Bernanke to come here and say, you know, we need something more conditional, more forward-looking, more pre-commitment than the previous flexible inflation target, but that ain't going to save you from what we got here. And that ain't going to explain why we got where we are. So I take Larry's implicit, I hope, promise that every 2 years we can hold another one of these. We now have the copyright, and I think we upgraded even the already high quality. But I want to be more hopeful, and I want to push all of you, including the Peterson Institute associates, to be a little more ambitious and radical than what Olivier is predicting we're going to have over the next couple of years. Anyway, that's my speech. I apologize. Let us open it up for if a few of you dare to have questions for these two. We don't have the traveling mic. Oh, dear. So, Jeremy and Justin, can I ask you to go to the standing mic? I apologize.
So
Here it comes. Yeah.
okay. Say I'm sold on the 4% inflation target. It's a good idea. And I'd be happy to wake up in a world where we were at 4% inflation. How do we get there? I mean, Japan, everybody's been sort of trying to get their inflation up, unless you really believe, which I don't think you do, in some real powerful magic of expectations just kind of making it happen. Isn't it going to be kind of embarrassing to announce a 4% target and then just fail to get there for 10 years?
Yeah. So I think there are two issues. There's the political economy issue of whether you can do it. But the mechanics, no, I think it's actually very easy to do. I have absolutely no doubt that if we keep the interest rates very low for long enough, the unemployment rate will go to 3.5, then 3, then 2.5, and I promise you at some point that we'll have the type of the rate of inflation you want, even more than 4% if you want it. Now, I think from a mechanical point of view, I have absolutely no doubt that that's feasible. You just keep the interest rate at zero as the rest of demand is growing, and unemployment will keep decreasing and pressure will come. I think the political economy of it is much more difficult. The best thing is for this to happen by accident. And then you say, now that we're at 3, do we really want to go back to 2? Where if you're seen as, without having prepared the way, as going to 4 kind of in a hidden way, then you get in trouble. But mechanically, I have absolutely no doubt. This is the whole discussion about the Phillips curve, which we had yesterday. And I guess that my friend there is going to disagree.
Yeah, I'm not. You might be right. I'm not confident that you're not right, but I kind of think Japan sort of tried that experiment, zero. They kind of had zero inflation. They kind of did a bunch of intervening to devalue the currency. They kind of announced that they were having a new norms of higher inflation. They kind of got rid of all this central bank cooperation stuff, independence stuff, and basically had the prime minister and the central bank governor have press conferences standing next to each other. They convened business leaders and told them to raise wages fast to get expectations up. They kind of got the economy being white hot in terms of the traditional unemployment rate, and they can't get the inflation rate to 2, let alone 4. So maybe you're right, but it seems to me to be a fairly profound issue, and maybe we should highlight it more. Here's a way of putting it. We got a usual dogma. It's kind of a usual, it's from the central banker speech book, which is there are limits on what monetary policy can accomplish. Monetary policy can influence nominal things. There are limits to what it can do on real things, which go to the workforce and the culture and a whole set of things. That's like the standard central bank speech book. But the central bank speech book does sort of claim that the central bank can control nominal things. And that proposition is in some question. Now, I think part of what that's wrapped up in is and I have a sense this is a little more important than we've maybe given it. When I studied macroeconomics with Olivier, kind of like a big thing was that money paid a zero interest rate. And so when you change the stock of money, since its price was zero, all the other prices changed. And then when all the other prices changed, really dramatic things happened in the economy. Now, money pays the interest rate. It pays basically the floating rate T-bill rate because it's bank reserves. And so when you change money, you're kind of changing the amount of floating rate debt. Well, okay, you're kind of changing the amount of government debt. Well, why exactly can you achieve any inflation rate by changing the amount of floating rate debt? You don't have all the stuff in the Patinkin textbook. All you have is Olivier's Phillips curve and some tâtonnement kind of notion that if you kind of make the economy be overheating enough, then you must get inflation. And, that may well work out right. I'm just less confident that we understand it all. I think we're in a world that is more divorced from the quantity theory of money stuff that shapes all of our intuitions. And therefore, I am less confident about all propositions. Now, we could, and I don't think and this is only suggested in fringe places, we could go back to some idea. We could announce that we're going to have a kind of whole new theory of this. We're going to shrink balance sheets back a lot, and we're going to go back to the world where money doesn't pay interest, and where we insist that money doesn't pay interest. And then maybe we can get back some of the properties of the old world where we're more completely confident. That might be an idea, I don't know, but I'm less confident about all this than Olivier is.
Good. Let me just answer quickly. I mean, if you think about how you get wage inflation and price inflation up, there are basically two ways. There is a magic way, which you get expectations of inflation up, and then people expect high inflation, ask for higher wages, and so on. That has turned out to be incredibly difficult. I think that's what Japan tells us. Basically, manipulating expectations is very hard. But even given expectations, even if people don't move expectations, I have absolutely no doubt that an overheating labor market will put pressure on wages and will lead to wage inflation. I don't know exactly at what unemployment rate this will happen, but if you can basically get unemployment...
And do you know for sure that you can get interest rate? Are you 100% confident that you can get interest rates low enough, given the zero lower bound, to get the labor market to overheat enough to cause your outcome? That's the problem with that total serenity.
It's important to be serene. If I can get unemployment down to 3%, I think your problems are solved, basically. There'll be inflation, expectations will adjust, eventually we'll get there. Can we get unemployment down to 3% with just monetary policy by keeping rates at zero? I'm not so sure. Maybe we need some fiscal expansion, maybe. But again, I mean, if you give me the fiscal tool, I'm quite sure I can get you there. It can get you to 1% unemployment if you want. I'm not sure I want to go there.
Well,
all right, let's find some fresh meat for the consensus. Justin.
I was struck by Olivier's forecast at the start there that if the choice is evolution or revolution, we're going to end up with neither, either status quo plus or evolution minus. And I guess if we wanted to sort of answer Adam's telling us to go out there and actually change things a little, it'd be useful to have a theory as to why we'll get neither evolution nor revolution. And so, I can think of some. One is it could be that the state of the economy just doesn't support either, that you're both well over your skis and neither is called for. Another would be macro policy happens through institutions and they're big and sluggish and hard to turn around. There's the three Ps, political economy, politics, and populism, and maybe somehow they're the constraint here. I sort of heard Larry suggest a behavioural version, which is the case for evolution is actually a tail risk case. Maybe the modal model of the economy is the current one, and you're talking about sort of other states of nature we should be worried about. And then the final possibility I thought about is sort of the sociology and organisation of our field. What's not represented, macroeconomics is a tribal sub-discipline. There is a tribe that has been silent or not here for the past day and a half. We have a bunch of other weird sociological things. I've already written my macro lectures for next year. I'm not going to go back and change them. It's too much work. So, why is it you see you're pessimistic about progress?
I'm less. Look, I had I've been in some modestly senior positions in government, and it's much easier to kind of be here at the Fed, be here at the Peterson Institute, and be at the conference and say that we need a new monetary targeting regime and get rid of the 2% inflation targeting regime, than it is to decide now I'm the chairman of the Fed. I'm in the building. I'm carrying the weight of all that tradition. There are a variety of constituencies with which I have to deal. I'm going to devote my chairmanship of the Fed to having there be a 4% inflation target. Those are two quite different things. And by the way, they probably should be. It's not irrational for the world to have a much higher threshold for making actual radical change than the Peterson Institute has for saying that was a really great paper proposing a really interesting change. That's probably how the world ought to work. So I didn't think when I was in government that it was my job, when somebody had done a really interesting paper and proposal that lots of other people thought was a really good idea, that it was necessarily my job to go implement, that I would be serving the people best by implementing it as quickly as possible. I kind of thought they were probably doing their job and I was probably doing my job, and depending on the magnitude of the problems and the degree to which everybody was convinced, attitudes would change and the world would move, and conferences like this are a part of that process. I do think, and here I would kind of agree with Adam, that if you're not in government, it's not especially valuable to be sound, and that ideas are like options, and it's better to raise the level of variability, because if somebody has a very good one, then that's terrific, and if somebody has a bad one, everybody will decide it's stupid and it won't happen. And so I'm more. If I was unhappy about something, it seems to me I'm more distressed by the fact that so much of the intellectual community around these things doesn't seem to be saying that there are big problems with the status quo and seems to be minor repairing it. That's more troubling to me than that the world isn't going off on toots. Look, it's taken to be controversial for a second, and to say things more starkly than he did. I think basically the idea of running some regression that shows that some Gini coefficient being high predicts slow growth, and then saying because of that regression, the world should lurch to redistributive policy, not recognizing that there's a big difference between organic inequality and inequality achieved through redistribution. I think that's a high order elementary error. And to be perfectly frank, I think the IMF at the highest levels has committed it for the last year and a half. And if there was more, so I think there are serious concerns also about having adequate filtering of interesting, good ideas from into their conversion into official statement and action.
Can I? I'm sorry.
No.
Hey.
You can, but we also have two very good people waiting, so go.
But, on every issue we disagree, so I actually largely agree. Just a few points. I think I like the points that Justin made. I think fear is largely gone, and basically you need fear to actually get change. I think that's a big dimension. Then there's a difference, I think, between monetary policy and fiscal policy. Monetary policy, I think central banks are conservative, not in the usual sense, but in the sense of not liking to change. And that's very powerful. And you see it when you discuss anything in a central bank. On the fiscal side, I think it's different, and I'll defer to Larry. My impression is a typical Minister of Finance or Secretary of the Treasury has to think about all kinds of issues which are very short run, very micro, and basically thinking about these issues, automatic stabilizers, is not the natural part of the job. So there has to be somebody there who actually cares and pushes. But probably it's not going to be the minister himself. At the same time, things happen. I mean, just again, to go back to Larry, you introduced index bonds, if I'm right. You probably had to do a lot of lobbying inside, but it works, so it happens. And I think Macron in France is also trying to do things along similar lines, so it can happen. But it's not the natural structure of a place to deal with the issues we tried to deal with yesterday.
Yeah, but index bonds happened. Index bonds in the United States happened after there was after for 15 years there'd sort of been a consensus of places like the Peterson Institute that they would be a good idea. And some of the ideas that some of us favor aren't yet consensuses at the Peterson Institute, let alone settled consensuses for 15 years. Look, I think on fiscal policy, the world ought to be kind of absorbing the idea that there was almost certainly a mistake made in 2010 in lurching toward consolidation too fast. And the world ought to absorb the idea that because we have a low interest rate, we should probably think about debt to GDP ratios differently than we would when interest rates were normal. And then there's some other bolder ideas, which I think the world ought to be thinking about and debating, but probably shouldn't at this moment be absorbing as the center of its policy process.
I'm going to exemplify the change I wish to be by not commenting. Carmen.
So some of the discussion reminds me of something my mother once said. Carmen, I'm not learning English fast enough and I'm forgetting my Spanish. And I think we're forgetting also a lot of old policies in this discussion. When we look at the history of the Federal Reserve, what you see is a history in which went well beyond controlling short-term interest rates. Since the crisis, we've said, yes, we have these one-off unconventional policies. But the fact is, we went through a long period in which inflation was the only goal, interest rate was the only instrument. Now we've brought back more goals. So we have inflation goals, we have financial stability goals, but we haven't brought back instruments. And when one looks at the menu this is what Raghu was also talking about, when one looks at the menu of things that emerging market central banks do, it's the kind of things advanced economy central banks turn up their nose to. Should we? That's a little remembering the past. Things, if you're worried about asset bubbles, or curtailments of credit and other features that we've long forgotten, part of the story. The other one, and here I'm afraid people are going to throw fruits and vegetables, is the issue of debt restructuring. Every time I bring up the term debt restructuring in the context of advanced economies, people think of chaos, they think of market events, they think of credit events. Not every debt restructuring is a credit event. When it's official to official, they're non-existent events. Let me give a concrete example. How much of the Japanese debt does the Bank of Japan now hold? What prevents an arrangement among official creditors and official debtors? How many of us really lost a lot of sleep when in 2011 Ireland and Portugal had their officially held debts restructured? Debts that are in official hands, and that's a growing share of debt in the advanced economies. There's a lot of leeway. Last example, and I'll stop there. The Fed Treasury Accord in 1951 involved a restructuring of U.S. debt. Short-term marketable bills were converted into 29-year non-marketable bonds. An agreement between the Treasury and the Fed. What is that? Why am I not hearing that in your paper? That, is a way of dealing with some of the debt overhang. that sounds a lot more revolutionary than it actually is when it is among official creditors.
Thank you, Carmen, very much. Before Larry and Olivier jump in, and I love them to respond to that, I have a public service announcement for Peterson Institute employees. Some of you and I were supposed to be meeting with a finance minister at the moment. Those of you who are, that means Joe, Jerome, and a few others, go upstairs since we're continuing the conference here. Thank you. Larry.
I didn't follow all your examples, Carmen, and we can take some of this up later. Look, I think I said it a little bit yesterday, and I've said it in a variety of places. I think it's roughly nuts that we've got two debt management policies in the United States, the central bank debt management policy and the Treasury debt management policy. And I think we ought to have one debt management policy that kind of works it out, that refers to the debt of America. And that might involve a variety of the kinds of restructuring you're talking about. That notion is not highly valued because it's thought to intrude on the independence of the central bank in some way. And I think the potential benefits of having a consolidated one country debt management policy strike me as large, associated with any costs of the kind of costs in terms of foregone independence. I think there is. Then there's another issue that I thought you were referring to that is alluded to in Olivier's and my paper, which is sort of how much do you have to remove all the blockages by restructuring, like the debt of the mortgages and the houses that are underwater and the sort of private sector debts. And my general view in 2009 was, when you restructured debt and you made banks write down debt, potentially you were losing $1 of capital for each dollar you restructured. And maybe that was going to cause, if they had a capital ratio of 8%, $12 less lending. And if you wrote down some $1 of mortgage debt, maybe somebody was going to feel rich, that you were going to save them 5 cents of debt service, not $1 in a short run. So maybe you were going to get them to spend an extra dime. And at a moment when the economy was falling apart, there didn't have to be very many cases where you increased spending of the beneficiary by a dime and you reduced spending caused by the loser by $12 to leave you behind in terms of stimulating the economy. But there's a kind of serious set of views that that's all wrong and that it's not about the intermediaries, it's about the people who are the holders of the debt, and that there should have been more debt restructuring. On balance, I don't agree with that view, but it's a very live, active, reasonable debate.
May I? My sense is that we actually addressed your issue. I mean, for example, the title of the paper that we gave yesterday is called Back to the Future. And the theme is that we indeed have to go back to a world in which, policy had many tools, many instruments, rather than just what we ended up just before the crisis with inflation targeting and the Taylor rule. So I think I completely agree with you that there were plenty of things which were done in the old days, which might be, which we should consider again. In practice, actually, I think with respect to the last session, the international macro session, this is where I've seen the most progress, which is that it is now fairly widely accepted that capital controls can be acceptable in some circumstances. Then FX intervention may work, may be acceptable. So I think there has been a shift there in terms of using a number of instruments rather than just the exchange rate. I think the spirit is the same with respect to macro-pro, except that I think there has been less progress actually on macro-pro than on these cross-border issues.
Thank you. Catherine Mann of the OECD gets the last question.
So I haven't had the opportunity to be here for a day and a half, but I've come up to speed pretty quickly by being here for the past hour and a half. And the reason why I haven't been able to be here is because I've been with the G20. And I've spent a lot of time with the G20 over the last 3 years. And so one of the rethinkings of macro should really be about why is it that when you have the finance ministers and the central bank governors having to sit in a room together for such a long time, because these meetings do last a long time, why is it we cannot get more coordinated policy that actually is effective? Why is it that even though they sit next to each other, they go to their respective corners when they go back home? So there's an institutional problem of bringing the two pieces of macro policy together. It's an ideological problem. I think in Justin's words, it's tribal. But until we get over that, we're not actually going to be able to either have even the evolution, much less the revolution.
Well, but I guess some elements of that, and I helped to work to create the G20 because I believe in international cooperation. But it was sort of tell you one story that sort of brings like one aspect of this home to me. In 1993, as the Undersecretary of the Treasury for International, I went off to Geneva because there was a discussion of the WTO in a variety, and I was mostly there to discuss the WTO, the financial services and free trade in financial services issues. But 4 days before I was there had been a set of proposals to bring certain aspects of taxation into the realm of the WTO. And my colleague who was in charge of tax policy had said that the United States wasn't going to do that. Just wasn't. Because the United States did taxes its way and it taxed worldwide income its way. That was just kind of what it did. And 178 nations disagreed. And Assistant Secretary Les Samuels said how it was going to be. And I kind of believed a little bit in international cooperation and effort, so I kind of thought that was a little unreasonable. And so I talked to Les, and he basically said, get a life. We're not turning over tax. The IRS, we're not going to turn it over to like 178 countries in some one of your Geneva tribunals. And it kind of seemed he was being a little unreasonable. He was, after all, only an assistant secretary. So I required the subject to be discussed with the Treasury Secretary, who was Lloyd Benson, who looked at me like I was a complete lunatic for having this idea. And the point of the story is the reason they don't cooperate is because then they go home and they're embedded in a domestic political system that does not care what the rest of the world thinks about a lot of things that are fundamentally important in the domestic world. And I don't know, democracy, all that. I'm saying I worked to cause us to be more cooperative.
Larry, it's why doesn't the Treasury and the central bank within a country work together? Forget the international cooperation aspect of it. They don't even talk to each other in their own country to have a common policy.
Well, that would not have been, that actually would, that aspect, I would say, and I think Ted will vouch for this, during my time of relevance, I don't think you would have said that about the Treasury and the central bank, but this is part of why I have been saying that I think we need to, in a world where we have too little inflation, not too much, we need to get a little less theological about central bank independence, precisely with a view to achieving that kind of coordination. But that is, many regard going near the notion of central bank independence as a kind of third rail. And and I think the debt management example is a good one. Cooperating on a common debt management policy, I would argue, is way short of the Treasury saying what the short-term interest rate is going to be. But lots of thoughtful people think that that's fairly fundamentally threatening to central bank independence.
Let me close it off here, as a small country's about to declare war on the Peterson Institute, which I don't expect the Trump presidency to protect us from. As someone who 25 years ago with Olivier and my dissertation committee questioned the value of central bank independence, I'm kind of glad to hear that we're ending on this note, because it goes back to something Larry and Olivier said and something that Justin raised, which is, yeah, we have to, and Carmen, I think, raised it beautifully. We do have to question some of the sanctimonious theological beliefs in the profession. That was a problem in financial deregulation, in my opinion, 15 years ago, 10 years ago, that one could not say, oh, geez, this may not really work, that you were looked on as stupid and behind the times and crossing theological barriers. So what will come away from the conference, of course, is the specific analytical contributions of so many people, and especially Larry and Olivier, but I also hope a little bit of the spirit that we can't just stick with business as usual completely, at least when discussing these matters, also carries through. I cannot thank enough Laren Summers, member of the Executive Committee of the Board of the Peterson Institute for International Economics, and Olivier Blanchard, the C. Fred Bergston Senior Fellow here at the Peterson Institute, and everyone for making this, I hope, a turning point conference. Thank you very much.